I'm Tiffany Lorraine, and I am giving a presentation on Chapter 8, Number 7 for Accounting 201 with BYU Idaho, Section 17. First, I'm going to share one of my slides and explain some of the basic terms and definitions that we need to know for what we're doing. We're doing the disposal of plant assets. That is the process in which assets are discarded once they are no longer useful for the company and have no market value. Therefore, you must understand how to determine the current and expected value of an asset. So one of those aspects is that you need to know the useful life. The useful life means the time in which that machinery, piece of equipment, will be useful before it deteriorates or depreciates. This has a couple of different aspects, but the way to calculate useful life is doing the cost of the asset divided by the estimated years of use. So the cost of the asset could be something like $10,000, and they think it'll depreciate to the value of 0 in 10 years. So you would take 10,000, the cost, divided by 10 years to get the useful life value. Now, book value is not the same thing. It's a little different. You would take the total assets minus the total liabilities. Now, this could be at a different period of time within the useful life. So this book value may change depending on where it is in depreciation. The book value will also determine if it is a gain or a loss when that asset is discarded, which we'll talk about in a little bit. So depreciation, there are 3 formulas for determining the depreciation. There's a straight line depreciation method, diminishing balance method, and the unit of product method. So now what we need to look at is the value, okay? We need to look at how we determine the value of the asset. So this means we need to know the accumulated depreciation. We need to know how it's going to depreciate over time. And where I got mixed up and thought it would be important to note is that you really have to understand where something is going to add value to an asset and where something is the cost of the asset, which is going to decrease the value. Because this is a little bit easy to get mixed up because of some of the ways some of these terms are worded. So when you are calculating the gain or loss of a discard asset, you must be clear on what affects the value and what affects the cost. So to keep this straight for me, I put them in 2 columns. So assets and values, the things that are considered an asset or add value to what I'm dealing with is the accumulated depreciation. It's a contra asset account. The total amount an asset has been depreciated up to a point in time. It lets me know what is still valuable with that asset. And then extraordinary repair expense can be confused as an expense, but it actually is considered an asset because it's the extensive repairs that extend the useful life, that's the key there, of the asset and increase its book value. So this adds value to our asset. That's going to increase the number or give it a bigger chance to be a gain when it is discarded, or it may extend the life of the time period that it is used. So that will change the factor of how long it's going to be used, if it's going to be used longer, or if it's going to be discarded sooner or later than expected. And the expense side, these are the things that cost. These are the things that take away the value or are part of the costs of the asset. So we have depreciation expense. This is the side of what it cost us to invest in this machinery for our equipment. Or the example would be when you buy a car, it depreciates the minute you get off of the lot. So this is the expense of the things that would be involved with that. This is the amount that the company's assets are depreciated for a single time. So a period of time. So this can be a period of time along the way, maybe 5 years into 10 years, maybe the full 10 years, something to that extent. It's somewhere in that period of time of depreciation. Now, an ordinary repair expense is an expense. This one is the maintenance expenses in the current period that do not affect the value of the asset. These are things that just maintain your vehicle, for example, oil change, car rotation, windshield wiper fluid, the things that keep the machinery running and moving smoothly. These are the things that have to be maintained every day, every month, in order for it to even be usable. And that's the difference between the extraordinary repair expense versus the ordinary repair expense. Extraordinary is going to add value. All ordinary is going to do is keep it running and maintained. Now, there are a couple different ways to accumulate depreciation, which you're going to need to know. The basic formula is to do the cost of the asset minus the salvageable value for the life of the asset. Now, salvageable value is different than the book value. This is the amount that is still available after the cost. And then you need the number of years. And if you're calculating months, you need to divide that by 12 to get the months that are involved. There's three ways to do this. We have the annual depreciation, asset minus salvageable useful life in years. Second way is the annual accumulated depreciation equaling the current book value times the depreciation rate. And then we have double declining balance method where you take 100% divided by the useful life of the asset and then times that by 2. The two concepts that we have learned are 1 and 2. And so if you have the book value and the depreciation rate, you can get this amount. Or if you have the asset value, the salvageable value, and the amount of years that it will be useful, you can find the accumulated depreciation. And the last concept here that we need to understand what we're doing and what's in number 7 that's so important is that we're deciding if we have a loss, a break-even point, or a gain with an asset. So what we're being asked to do in number 2, 3, and 4 of number 5 is to enter these correctly with different amounts, and each amount determines something different. So you're going to notice that the number 2 is going to be calculated this way, where there is a loss, and number 3 is going to break even, and number 4 is going to have a gain. Now, the best way I found to do this is to start with the cash amount. What was it sold for? You need that first. Then you need the amount of depreciation, and you can put that second. Then leave a blank space in the third line to decide if it's going to gain or a loss. You don't know what that is yet. So then go to machine. And on machine, you're going to put the full value of the machine when it was purchased originally. And so once you have those amounts, what you will do is you will take, for example, in this, you would take 500 and you would minus 80 and 20 in the first one, and you're left with an amount of 400. Or no, you would take, I've got this backwards. You would take 500. Okay, we're gonna try that again. So number 7 is all about the outcome of selling, discarding our plant assets. Now, there are 3 possible scenarios for this. Well, there's actually 4. So the first one is there's just no value left. And that's the first entry, which is number 1. And we'll go over that when we do the actual problem. And then there's 3 other options. There's either going to be a loss, a break-even point, or a gain. And this is how they are entered. Now, the simplest way to do this is first you need to understand what you sold it for. So you're going to put cash first. Always put cash first, what it was sold for. Then what you do know is you do know your accumulated depreciation, and you've done that one of the 2 ways explained before. And then on the third line, I'd actually leave that line blank because you don't know if you have a loss or a gain or a break-even point at this time. You're not sure. And so then you would add our machine, which is the original amount that the machine was purchased for. So in the first example with loss, for example, you would take the 500 minus 400 minus 80. and you'd realize that there is a loss of $20 there. And then you would record in the sale of machine below in the book value that there was a $20 loss to make this difference. And that is going to be debited so that both sides match. So if you have to debit the amount for it to balance, you know you have a loss. If the amount that it depreciated and the cash received, it does not match the value that it was bought for, you have a loss. And the second one, same thing, do cash first, then do your accumulated depreciation that you've calculated. And then you take that amount, and you'll notice on this case, both sides balance. So there is no loss and there is no gain. It is just broke even. And then on the last one, we get to experience what a gain would look like. So again, put your cash in first, what it was sold for. Put your accumulated depreciation. Notice that's the same across the board. The depreciation and the machine value are the same. The only thing that's changing is the cash or if it's a loss or a gain. So if I had the third one filled out and I didn't know if I had a loss or a gain yet, I know I'd have $110 and $400, which is $510. That is more than $500. So in order for both sides to balance, that needs to be credited as a gain on sale of the machinery. So in this case, selling, discarding the asset had a gain. And these are how your answers should be laid out in number 2, 3, and 4 of number 7. And you'll know that you have them laid out properly. And you will know if you're balancing them properly for a loss, break-even point, or gain. Now, after all of that, let's get to the actual problem here. So if you noticed, I already have it filled in, but I'm going to explain how I got those numbers. And your numbers are not going to be the same. So note that you're going to need to do this with the numbers in your problem. So up here, I have Diaz Company owns a machine that cost $125,500 and has an accumulated depreciation of $92,000. Lovely. They give us the accumulated depreciation. I don't have to go find it. And I have the total cost and value of my asset here. So now I'm going to prepare to record the disposal of this machine on January 1st. They already give me the date, so I also don't have to worry about that. This is one point in time. I'm not going to have to calculate months or anything like that. So what I am looking at is 1 through 4, how to do the journal entry properly, and if there's going to be a gain or loss or a break-even point. So the first thing that I'm going to use that I know is I'm going to debit the accumulated depreciation of the machine, which they gave me up here as $92,000. Then I'm going to leave the blank because I don't know if I have a loss. I don't know what I have here yet, but I do know my machine value. My machine value is the $125,500. So how I got this middle value is I took the machine amount minus the accumulated depreciation amount, which gave me, in my case, $33,500. Now, I noticed this, but I don't know if you noticed this. There's the same amount up here in number 3. So I noticed that and realized, oh, I'm probably going to have a break-even point with number 3 if I'm doing it correctly, because it matches this amount of depreciation. Just a side note. Number 2, we're going to do the cash first. We're going to do the accumulated depreciation. We're going to do the value of the machine. I'm going to add $17,000 to $92,000. I'm going to subtract that from the $125,500, and I get $16,500 as a loss because that is less than the value that I have here in order to get both sides to balance. Number 3, did the cash first. I did the accumulated depreciation, and I did the machine, and I noticed both sides matched, so I didn't need a third line. This already balances, which means there was no loss and no gain. Number 4, I did my cash first, my accumulated depreciation, and my machine. Then I took my machine value, and you can add these up first. And if you add these up first, you'll notice that's a larger amount than the machine. So then I knew to subtract this amount from the machine amount. Or if you did it the other way around, you would notice that this amount is larger than the original amount. Either way, in this case, it's a gain because these numbers added together are larger than the original machine value. So you know that it's a gain on the sale and machine, and it's going to go on the credit side, so both sides balance. And that is how you do number 7 of chapter 8 for Accounting 201. Check my work, make sure that this is all right for you. And here is the whole sheet laid out all together, which makes it a little easier to see. So we started with our general entry with no loss or depreciation, which is very similar to number 3, no loss, no gain. Number 2 is what happens when there is a loss. And number 4 is what happens when there is a gain. But in all these cases, when you're trying to find the answer, if you have the cash amount, you have the depreciation amount, you have the machine value, you have enough to figure out the loss or the gain. And that is my presentation. Thank you.